60-day pause, which, if you remember, under the Memorandum of Understanding, is meant to be in place, that ends on the 16th of August. Now, whether that really matters or not, we'll see. But so far, Iran has restricted itself to the sort of tit for tat. In other words, if the Americans attack them, then they attack the American bases around. But otherwise, they haven't attacked anyone. They certainly haven't attacked Israel. So they've actually respected this 60-day ceasefire, sort of. So I just wonder whether on the 16th of August, whether this is going to change. It could well do.
Geopolitical turmoil in the Middle East and closing maritime trade routes threaten to paralyze global energy flows. As crucial ceasefire agreements expire, international markets face an unprecedented supply shock. Alasdair Macleod, a seasoned economic researcher and financial strategist, warns that the end of the 60-day pause on August 16th will alter the conflict's dynamic. With shipping restricted through the Red Sea and Hormuz, millions of barrels of crude are trapped, which is predicted to trigger severe shortages of diesel, jet fuel, and heating oil. Combined with European crop yields dropping below half due to drought and Ukrainian grain exports blocked in the Black Sea, global food and commodity prices are set to surge dramatically. To prevent complete economic collapse, G7 central banks will inevitably resort to massive currency creation, driving fiat purchasing power toward a rapid breakdown. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
There's a threat of war or something like that. Gold seems to get hit. I mean, the market is so confused over this, and it doesn't help because of all the propaganda going around. I mean, President Trump has tacoed like 20 times on this. One day he says, we're going to bomb the bastards into the Stone Age, and the next day he says there's peace negotiations. Then the following day we're going to bomb them again, and then following day peace. I mean, it's just the fact of the matter is that the Americans have got themselves cornered at the behest of the Israelis, and it's not working out well for them at all. The other thing to bear in mind is that the 60-day pause, which, if you remember, under the Memorandum of Understanding, is meant to be in place, that ends on the 16th of August. Now, whether that really matters or not, we'll see. But so far, Iran has restricted itself to the sort of tit for tat. In other words, if the Americans attack them, then they attack the American bases around. But otherwise, they haven't attacked anyone. They certainly haven't attacked Israel. So they've actually respected this 60-day ceasefire, sort of. So I just wonder whether on the 16th of August, whether this is going to change. It could well do. The fact of the matter is that the consequences of the mistake of trying to attack Iran, leading to the closure of Hormuz, and now also leading to the closure of the Red Sea, effectively bottling up a further 7 million barrels a day of Saudi oil. This is a real crisis. Shortly, we're going to see diesel shortages. There's going to be no diesel, no aircraft fuel, no ship bunkers, no heating oil. All this comes out of refining sour crude, which is basically what we get out of the Middle East. This is going to hit prices, consumer prices, very, very hard later this year. And in Europe, we can couple that with the drought, which means that crop yields have fallen to less than half of where they would be expected to be. And just to make things worse, Russia has managed, if you like, to stop all shipping going into Odessa and the other Black Sea ports which were under the control of Ukraine. So Ukraine can't export its grain anymore. So global grain prices are going to be rising quite sharply. This is everything. It's a perfect storm coming together for governments, for G7 governments to deal with. So, what happens? Well, we know what happens. They will have to print in their effort to stop their economies tanking. Put aside the inflation sort of argument. What that really does mean is that the purchasing power of these currencies is effectively going to be running into a collapse. I mean, the fact of the matter is that when it comes to funding the expansion of credit in the form of currency and bank reserves, this funding is running into a brick wall. I mean, you've got debt to GDPs throughout the G7, which average something like 120, 125%. I mean, there are outliers like Japan on the one hand, being 200 or 240%, however you measure it, and Germany, which I understand is around about, 75% now. But its economy is really, really struggling. They're in debt traps. So how do you get out of this risk? Well, the answer is you get into gold. And I think we're at the point where the markets should be waking up to this. I mean, they should have woken up to it a lot earlier. I mean, markets are effectively broken. And as to the point as to whether this move up in gold, if you like, is the start of a new trend, the fundamental facts suggest, yes, it is the start of a new trend. Basically, not because of the merits of gold or silver, but because of what's happening to credit. It is entering a stage of, a period of collapse. There is no other conclusion you can come to. The world basically works on credit, not on gold. Even when credit is tied to gold as a gold substitute. But, if you literally, I mean, there will be some variation, the value of a basket of commodities, but mostly that comes from the interrelationship between currencies and gold, not from gold itself. Instead of gold, you could buy any sort of commodity, but I mean, it would have to be, a basket of them to get rid of the individual characteristics. I mean, what happens if, let's say, suddenly nobody wants magnesium? I mean, the price would collapse. If they find a substitute for silver, complete substitute for silver, and let's just dismiss the monetary argument from it. I mean, it would collapse. I mean, what happened to silver in the 1870s was when Europe went off silver standards following the Franco-Prussian War onto gold standards, the silver ratio rose. I mean, it shot up from sort of 15-ish to, sort of 20, 25. Why? Because, the monetary value went out of silver. I mean, it wasn't demanded for its monetary qualities anymore. So, I mean, the point I'm making is that gold is representative of all commodities put together. Gold is the most convenient way of buying that basket. That's what it amounts to. You can buy silver and get a more volatile version of it. But then again, you're getting specific silver risks. So anyway, that's where we are.
Sovereign debt levels across major G7 economies have reached unsustainable thresholds, averaging between 120% and 125% of GDP. With extreme outliers like Japan exceeding 200% and Germany struggling under severe stagnation, Western nations are trapped in a structural credit trap. Because governments cannot fund expanding credit without generating equivalent national liabilities. Paper currencies are entering a fundamental phase of system failure. Under these deteriorating monetary conditions, traditional financial markets are effectively broken, positioning physical gold as the premier hedge against sovereign credit risk. Unlike individual commodities susceptible to demand shifts or technical substitution, gold represents a stable proxy for a complete commodity basket. As the purchasing power of credit degrades, capital shifts away from paper liabilities toward tangible monetary reserves. Now, let's get back to the interview.
We've had a consolidation of bond yields after an initial rise post-COVID to around about 5% in US Treasuries, similar level I'm talking the 10-year rate, similar levels in dollars, etc. I mean, the European ones, if you like, are the ones which are low, along with Japan. But that is now threatening, if you like, the yields are now threatening to break out above that. Now, if they do that, then that will create an equity market crash, a global equity market crash starting in the US. Already, if you look at US equities relative to bond yields, they are more overvalued than they have been since the financialization of markets, which goes back to London's Big Bang. I run a chart on this, looking at the negative correlation. What I mean by that is that if you get a fall in bond yields, you can expect a rise in the equities. If you get a rise in bond yields, you can expect a fall in equities. Bond yields have risen and risen and risen, and equities have not been. They have continued, if you like, to themselves to rise against a background of strong bond yields.
Just like gold.
The results of this is that equities are now, by just looking at that chart, which I produce, and you'll see it on my Substack, are now more than 3 times overvalued than the situation during the dot-com bubble. The psychology during the dot-com bubble was as extreme as anything we had seen in the past, including reports of the South Sea bubble in London, the Mississippi bubble in France at about the same time. That was a slightly different situation. And from your part of the world, the tulip bubble. This is an extreme. Now, the thing that will break it, obviously, is if we see the 10-year US Treasury yield challenge the 5-year, the 5% level. And if it goes through that, then equities are toast. There will be 2 very, very big sellers. There will be the banks, who own roughly 9 trillion as collateral, or have roughly 9 trillion in equities as collateral, which they will be liquidating, and foreign investors who at the moment have just under 25 trillion invested in US equities. They are there for speculative purposes. They're not there to see things fall. They will not hold on to their stuff, if you like, if they see a falling market. They will rush for the exit, because US equities are not their business. Their business is, in your case, Dutch equities, or in our case, British equities, or whatever. It always happens when you get a bear market, foreigners sell the foreign stuff. There is an overhang of nearly $25 trillion worth of foreign investment in US equities. They won't get out with 25 trillion, I can tell you. They'll be lucky if they get out with 4 or 5 trillion. That's what's going to happen. You're going to have a real crash because you've got the combination of foreign liquidation and at the same time, you'll also get investor liquidation in the US. But at the same time, you're going to have the banks force sellers into the market because they want to retrieve the value of their assets, which are loans to investors, hedge funds, etc., who have pledged against those loans equity collateral. So that's going to be the big thing. And you then have to ask yourself, how are governments going to respond to this? By governments, I mean treasury ministries and central banks. Well, the answer basically is that they will do whatever they can to try and support the economy, because they've been doing that for the last 100 years, and also support financial markets, because that is absolutely fundamental to confidence in the broader economy. This is what these guys believe, and they've got no option but to do it. There's a political imperative. So you can see that crashing equity markets, rising bond yields will trigger crashing equity markets, and that's going to collapse the value of currencies. We are end of life for fiat currencies, and so few people understand this at this moment, but it's going to be, I think, the way it's shaping up, it's going to be really quite sudden when it happens. Printing is debt. You can't run a balance sheet with just for one side, as it were, as you can, let us say, if you were debasing the coinage, which is a completely different operation with the same consequences, potentially anyway. If you're going to, let's say, credit more currency to the bank reserves, which you hold, which are the 2 ways in which the currency is effectively expanded, then you've got to expand the debt as well. So what do? I mean, basically, you've got to issue debt. Now, if we have a situation where you're in a debt trap, you're up against a brick wall. And the only thing you can do is issue increasingly short-term debt to cover your currency, as it were. So, the reliance on, on T-bills is going to increase. And not only will it increase, but the reliance on 6 months compared with 1 year T-bills, and then reliance on 3 months compared to 6 month T-bills. And eventually we'll be down to, 1 week maturities. Is the only way to sort of push the cost down, the cost of funding down, keep it as low as possible. But this will be reflected in the collapse of the purchasing power of the currencies. And I think it's going to happen really quite quickly.
An extraordinary valuation imbalance in global stock markets poses an immediate threat to financial stability. Relative to prevailing bond yields, U.S. equity valuations stand more than 3 times higher than during the peak of the dot-com bubble. If 10-year U.S. Treasury yields break above the critical 5% threshold, the mechanism will trigger a major stock market crash starting in American equities. This structural breakdown unleashes double-sided selling pressure across the financial sector. Foreign investors holding nearly $25 trillion in U.S. equities will rapidly liquidate their positions to exit an unstable market. Simultaneously, commercial banks holding approximately $9 trillion in equity-backed collateral will be forced into aggressive forced liquidations to secure their loan portfolios. To cushion rising interest burdens and maintain funding, fiscal authorities will continually shorten debt issuance maturities, transitioning from yearly bills to 6-month, 3-month, and ultimately 1-week durations. This reliance on short-term funding accelerates the overall breakdown of fiat currency viability. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.